We are 2 months away from the end of 2023, and loads of gold price predictions have started popping up for 2024. Goldman Sachs, the IMF, Morgan Stanley, they all have a go at predicting where gold prices could end up. Today, we are looking into these predictions, but first we will discuss the current price of gold and what is actually driving the outlook for the gold market. Factors like interest rates, inflation, supply and demand, these are crucial because without understanding these, we are just shooting in the dark. Okay, so how has gold done so far in 2023? Gold started the year at $1,820. We can see the steady support level here between $1,800 and $1,825, which I've talked about repeatedly in my videos. Gold reached a new all-time high in May, hitting $2,081 for the first time, before hitting a support level at $1,900. We then had a sharp sell-off around the start of October, but the gold price bounced off the $1,800 support level. Today, 27th of October, gold is trading at close to $2,000, which gives us about an 8.8% return year to date. The biggest gold ETFs, GOD, GODM, IAU, have only returned about 7.6 to 7.8% though. That's about 1% less, and it's because of factors like expense ratios and premium or discount to net asset value. This return almost matches the S&P 500's return of 8.3% so far this year. We can also see that they have been negatively correlated over the last 6 months or so. I don't know if this is going to continue in 2024, but it's interesting to watch this relationship. So, why has the price of gold moved up, and can we expect it to stay up? There's a few reasons, but one of them is sticky inflation. Even though US inflation is down to just 3.7%, core inflation is still 4.1%. That's the more important metric that the US Federal Reserve uses because it strips out items like energy and food, which are a lot more sensitive to seasonal fluctuations. Anything above 2% is problematic, and I know it may not seem a lot to you and me, but it is a lot for the Fed. The expectation here is that inflation will even out over the next year and fall below 2% sometime in late 2024 or even 2025. Most people assume that inflation causes gold prices to go up, but that's not exactly the case. Researchers haven't really established a strong relationship between gold and inflation since 1975. The ratio of gold price to CPI has been 3.2 on average since the gold standard dropped. It was 7.31 when the study was published in 2011, but currently it stands at about 6.5. People always argue about that, they write articles, examine data, but at the end of the day, I don't think we have strong evidence to suggest that gold is a reliable hedge against inflation. Now, what inflation could affect is the all-in sustaining cost, or AISC, for gold miners. AISC is the full cost for gold miners to mine a single ounce of gold. As of the latest data, this stands at an all-time high of about $1,307 per ounce. Since 2020, that has gone up by about 30%, the fastest increase in a very long time. AISC is important because it essentially puts a floor on gold prices. If gold prices fall below $1,307, over 50% of gold miners will not be profitable, and they can simply stop operations or stockpile gold, thereby making gold more expensive by reducing available supply. If we look at the curve, we can see that most gold, 94% of it, is mined at AISC under the current gold price of about $2,000. When gold prices fall or all-in sustaining costs rise, more miners become unprofitable. This reduces supply and puts pressure on gold prices. The way I see it, inflation doesn't directly affect the price of gold, but it affects the production cost of gold, which then plays an important part when estimating gold prices and value. If inflation goes down like expected next year, the all-in sustaining costs may stabilize or decrease, and that could drive gold prices down. A quick note here, a lot of gold is being produced in countries like Russia, Kazakhstan, Uzbekistan, Ghana, South Africa and Brazil. These countries saw higher inflation than the US, so even if US inflation goes down, the inflation there can still push up the production cost of gold up. Interest rates also affect gold prices, and usually there is a negative correlation. In plain speak, this means when interest rates go up, gold prices go down and vice versa, but that's obviously not always the case. Right now we have the highest interest rates since 2006. This is probably the peak for now. Maybe they'll go up by another quarter or 0.5%, but that's it. The expectation is they are coming down a bit next year, then a bit more the year after. Jerome Powell has repeatedly said that the Fed may need to keep rates up for longer than expected, so maybe the expectations are optimistic. If rates remain at the current level, gold prices could start going lower. There's a lot of complex reasons and relationships behind it, but the essence of it is gold does not earn any interest. With risk-free bonds yielding 5.5%, more money could flow out out of gold and into bonds. Now, gold prices actually started rallying all the way back in September 2018, going from $1,180 to a peak of $2,075 in August 2020. As soon as interest rates started going up in March 2022, gold prices went down. And we can see how they moved opposite for half a year before gold prices hit a strong resistance level in October 2022 and came back up. We can see the effect interest rates had on gold, so we could extrapolate and say that if they start going down next year, that's gonna be good for gold prices. To what extent? Well, it's hard to tell, but as we can see in the bounce back in October here, there's other factors at play. One of them is currency strength. The gray line here is the dollar index, and we can see how this and gold prices have moved in a sort of negative relationship. Just like with interest rates, this isn't a 100% relationship, but generally speaking, higher, stronger dollar tends to lead to lower gold prices. We can see that a few times over the last 5 years. The reasoning behind it is that a lot of investors use gold as a currency hedge and to protect their wealth. That's not just in the US, that's all over the world, UK, Germany, Italy, France, even countries like China, India, Mexico and Brazil. In fact, the go-to investment in a lot of developing countries are gold and real estate. India, China, these are massive gold markets, and we will look at some stats in a bit. But my point is that currency fluctuations can affect gold prices and the demand for gold, and that's something to watch. It's hard to say how the dollar index is going to do in the future, because that takes so many variables. But there is one thing that could affect it, and that's de-dollarization. This also ties into the next factor I wanted to talk about, geopolitical tensions. First of all, we have the BRICS alliance, and they are trying to become less reliant on dollars. In the middle of October, we saw Egypt issue the first yuan-denominated panda bonds, which is setting a new precedent. BRICS countries are also pushing for the use of local currency for trading, instead of using dollars. This does not mean completely avoiding the US dollar, at least not yet, but they are heading this way. This is important because a lot of developing countries want to join BRICS, over 40 countries in total. Over time, say a decade or two, this can definitely lead to decreased dollar usage. Saudi Arabia, UAE and Iran, among others, have expressed interest in joining BRICS and also trading oil in yuan, which could start biting into the dollar status as a reserve currency of the world. The dollar will probably remain #1 worldwide reserve. I want to clarify that, but this could still affect the strength of the US currency negatively and the price of gold positively. We also have more conflicts around the world, which naturally make people and investors worry. Gold is a common choice for a safe haven asset, and gold prices do jump when conflicts happen. If we look at the gold chart, we can actually see that the latest jump in gold since the start of October coincides with the situation in Israel and Palestine. There is a growing tension around Taiwan too. Ukraine and Russia are still in conflict. All of this leads to uncertainty, panic, fear, and that means more money flows into safe haven assets like gold. Finally, we have the gold supply and demand data. Unlike other metals like silver and copper, where industrial use is high, less than 10% of the gold supply is used in industries. That means demand is driven by investments and central banks, is a lot more volatile, cyclical, jumps up and down, so it's a lot more unpredictable. For Q2 of 2023, we had a sharp drop in demand because of less purchases by central banks, outflows from ETFs, and a small decrease in jewelry demand. Meanwhile, supply remained steady, ending with a surplus of about 334 tons, according to the data from the World Gold Council. We still don't have the complete data for Q3 and Q4 obviously, but central banks stepped up purchases with net 55 tons in July and net 77 tons in August, so the surplus has definitely gone down, but it's still there. That's not great for people who want higher gold prices. So, we have all of this information, we've taken a good look at it. What can we expect from gold prices? Honestly, it's a bit mixed, and we can see that in the analyst expectations. Right now, we have gold price predictions ranging from $1,700 from the World Bank and $1,775 from the IMF to JP Morgan's $2,175 per ounce and Goldman Sachs' average gold price of $2,133. We also have ING who are contributing a lot to this conversation by just expecting higher gold prices. You just gotta love ING and their detailed commentary. Now, personally, I'm not seeing any bullish pressure on gold prices right now. Inflation is subsiding, interest rates are not going down substantially next year, there is a surplus of gold. The way things stand right now, I think the most likely outcome is gold prices fluctuating between $1,800 and $2,050. We have a very strong resistance at $1,800 that's been tested a few times over the last 3 years. There is also the absolute bottom resistance of $1,640, but I don't think we'll see that unless something major happens. On the upper side, we have a strong resistance around $2,000. Gold prices have broken it a few times since 2020, but they always correct within a week or two. Again, I don't really see any strong reasons for gold to stay this high. I think geopolitical uncertainty can push it up, maybe even to $2,100, but on average, I think gold prices will stay below $2,000. Regardless, I am still buying some for the long term, alongside my global equity index fund. Currently, I have about 5% of my assets in gold, and I will maintain this ratio for the time being. There is a lot of info I haven't covered, but I hope you understand the big picture a lot more now. What do you think? Are you buying more gold? Are you buying silver? Are you passing on them altogether? Let me know in the comments below, and please leave a like if you enjoyed this video. Thanks for watching, and I'll see you again soon.